This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. The Federal Reserve cut interest rates 3 consecutive times in the second half of 2025, dropping the federal funds rate from 4.75% down to between 3.5 and 3.75% by year-end. Financial markets expected that trend to continue into 2026, with forecasts calling for multiple additional cuts to bring relief to borrowers struggling with expensive mortgages, car loans, and credit card debt. But by January 2026, cracks were forming in that narrative. Inflation remained stuck above the Fed's 2% target. The labor market showed surprising resilience, and political pressure from the White House intensified. At the January meeting, 2 Fed governors dissented and voted for another cut, but the majority held firm. The question heading into February was simple. Would the Fed resume cutting rates, or was the pause the beginning of something more permanent? On Tuesday, February 18th, the Federal Reserve released the minutes from its January policy meeting, and the tone shocked markets. Several Fed officials discussed the possibility of raising interest rates if inflation remains stubbornly elevated. While the minutes fell short of suggesting most officials were contemplating rate increases, they made clear the Fed is shifting further away from agreeing on another cut. The committee voted 10-2 to hold rates steady at 3.5 to 3.75%. 2 governors, Stephen Miron and Christopher Waller, dissented and argued for another 25 basis point cut, citing softening in the labor market. The backdrop is complex. Fed Governor Stephen Miron has penciled in 150 basis points of rate cuts for 2026, far beyond the median Fed members' estimate for just one 25 basis point cut this year. Miron believes the neutral rate, the level that neither spurs nor slows growth, is lower than previously thought because immigration policy changes have pushed down population growth, which he expects will lower inflation. Meanwhile, other officials warned that downside risks to employment have moderated while the risk of persistent inflation remains. Then on Friday, January 30th, President Trump nominated Kevin Warsh to replace Jerome Powell as Fed chair when Powell's term ends in May. Warsh is known for his hawkish past and unorthodox views on aggressively reducing the Fed's balance sheet. Markets slid on the news, with the dollar and Treasury yields rising as investors contemplated what Warsh's leadership might mean for rate policy. Trump has repeatedly demanded the independent central bank slash rates to as low as 1% immediately, but Warsh will need to balance that political pressure with the Fed's dual mandate of stable prices and maximum employment. The CME Group FedWatch tool shows markets pricing in just a 36% chance of a rate cut at the September meeting, down from earlier expectations. JP Morgan Research no longer expects the Fed to cut rates at all in 2026, citing stabilizing labor data and the unemployment rate ticking down to 4.4%. Interest rates are stuck in place and might go higher. The Fed is caught between political pressure to cut rates, persistent inflation above target, and a labor market that refuses to weaken. Several officials indicated they would have supported describing future rate decisions as two-sided, reflecting the possibility of upward adjustments to the target range if inflation doesn't cooperate. The trend is no longer about when the Fed will cut again, but whether it might actually hike. Market analysts now expect rates to remain frozen through mid-2026 at best, with the first cut potentially delayed until after Warsh takes over as chair in May. If you're carrying credit card debt, you're stuck paying an average rate above 20% for the foreseeable future. Those rates track closely to the federal funds rate, so without Fed cuts, relief isn't coming. President Trump floated a proposal to cap credit card rates at 10% temporarily, but top banking executives called it an economic disaster, and it's unclear how or if it would be enforced. For homebuyers, mortgage rates are hovering around 6.15% for a 30-year fixed loan. They've fallen from over 7% a year ago, but the decline has stalled. Experts predict rates will average between 5.9 and 6.3% by year-end, better than 2025, but not the dramatic relief many hoped for. If you're refinancing, the math only works if your current rate is above 7%. Otherwise, you're likely better off waiting. Auto loans for new cars average around 7% if you have good credit, down slightly from 2025, but still expensive. Used car loans hover near 11.5%. Car prices remain stubbornly high, with the average new car costing over $50,000. So even modest rate relief doesn't help much when the principal is so large. On the flip side, savers are still earning decent returns. High-yield savings accounts and certificates of deposit remain attractive compared to pre-pandemic levels, though rates have plateaued. If the Fed holds steady or hikes again, savers could continue earning 4 to 5% on safe deposits. The next Federal Reserve meeting is scheduled for March 17th and 18th. Between now and then, watch for the February jobs report on March 6th and the February inflation report on March 11th. If inflation ticks higher or the labor market strengthens further, the chance of rate hikes increases. If both weaken significantly, the Fed could resume cuts sooner than expected. Also watch Kevin Warsh's Senate confirmation hearings, which should begin in the coming weeks. Senators will press him on whether he'll resist political pressure from Trump and maintain Fed independence, or if he'll pivot from his hawkish past toward the dovish stance Trump demands. Markets are already positioning for a more complicated 2026 than anyone expected. The days of predictable rate cuts are over. Now it's a guessing game that depends on inflation data, labor market signals, and political winds. Your borrowing costs aren't dropping anytime soon, so adjust your financial plans accordingly. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.